The importance of gap analysis in interest rate risk management. Interest rate risk can have a significant impact on the financial health of an organization. To effectively manage this risk, financial institutions use various tools and techniques, with gap analysis being a crucial one. In this video, we will explore the importance of gap analysis in interest rate risk management. What is gap analysis? Gap analysis is a technique used to assess the sensitivity of a financial institution's financial position to changes in interest rates. It involves comparing the institution's interest-sensitive assets with its interest-sensitive liabilities to determine the potential impact of interest rate changes on its net income and economic value. Importance of gap analysis. Identifying risk exposure. By conducting gap analysis, financial institutions can identify their exposure to interest rate risk. It helps them understand how changes in interest rates can affect their profitability and overall financial stability. This insight allows them to proactively manage their risk exposure and take appropriate measures to mitigate potential losses. Strategic decision-making. Gap analysis provides valuable information that can guide strategic decision-making within the organization. By analyzing the maturity and repricing characteristics of assets and liabilities, management can make informed decisions regarding funding strategies, pricing structures, and product development to optimize performance in different interest rate environments. Regulatory compliance. Regulators require financial institutions to assess and manage their interest rate risk effectively. Conducting gap analysis not only helps institutions comply with regulatory requirements, but also demonstrates their commitment to sound risk management practices. By maintaining a robust gap analysis process, institutions can enhance their credibility with regulators and stakeholders. Performance measurement. By monitoring the results of gap analysis over time, financial institutions can evaluate the effectiveness of their interest rate risk management strategies. It allows them to track changes in their risk exposure, assess the impact of their risk mitigation actions, and make adjustments as needed to improve performance and protect their financial health. How to conduct gap analysis. Data collection. Gather detailed information on the institution's interest-sensitive assets and liabilities, including their maturity dates, repricing schedules, and interest rate characteristics. Calculate gaps. Determine the timing and magnitude of cash flows associated with assets and liabilities to calculate the institution's asset-liability maturity or repricing gaps. Risk assessment. Analyze the results of the gap analysis to assess the institution's exposure to interest rate risk and identify potential areas of concern or improvement. In conclusion, gap analysis is a vital tool in interest rate risk management that helps financial institutions proactively identify, measure, and mitigate their exposure to interest rate fluctuations. By incorporating gap analysis into their risk management practices, institutions can enhance their financial stability, regulatory compliance, and strategic decision-making capabilities. Want to learn more? Claire Trifle on LinkedIn.